Welcome back. In today's video, I will be showing you how to solve a question with respect to currency options. If you have not watched my previous video on the forward contracts and the futures contracts, please do well to watch those videos because it will give you a better understanding on how to solve a question on the currency option. Today's lecture will be a build-up from previous lecture. If you have not subscribed to my channel, please subscribe and also share my videos with your friends writing the Strategic Financial Management examination. Okay, let's dive into the lecture. Currency option. What is an option? As the name implies, option. That means you have option to do something. So what is this option that we are talking about? So currency option is a contract that gives the holder the rights. So the option gives you the rights, but not the obligation to buy or sell a given quantity of currency at a strike price on a future date. So the option gives what? Rights to either buy or sell a particular commodity, but in this case, is to the right to buy or sell a given quantity of currency at a future date. So there are two types of option. We have the call option and also the put option. So what is the call option? The call option gives you the right or the obligation to buy. So anytime you are buying, it is referred to as what? A call option. So to buy a given quantity of currency at what? A strike price. Okay. The holder of the option expects the spot rates to rise in the future. Okay. So let me stop here. Remember, from the currency futures, it's the same principle that is going to apply here. In the currency futures, we said for any currency that you expect to rise, if you expect something to rise, what do? You buy it now. So that when the price goes up, you can do what? You can sell. The same thing with the currency option. The holder expects the price to rise in the future. Therefore, the holder will do what? Buy today with the intention to sell when the price is rise. The option will be worthless if spot rate on the exercise day is lower than the strike price, and as such, the option will lapse. So in the option contract, one thing you have to know is that the company can never make a loss. The loss that the company will be making will be restricted towards the option cost, which is the premium. We'll soon get there, but just know that the option holder can never make a loss. If the option holder will be making a loss, the holder will not exercise the option to buy or sell. Okay? A recap again, the call option gives the holder the rights to buy. So anytime you want to buy, you call to buy. So call option is a right to do what? To buy. Okay? So now let's look at the put option. What is the put option? The same principle from your futures contract is what will apply in your options contract. There is a little variation, but don't worry, we'll get there in the course of this lecture. So call option have been treated. Put option now. This kind of option gives the holder the right to do what? To sell. The right to sell, but not the obligation. So take note of that. It's not compulsory that when you have the option, you must sell or you must buy. It just gives you the right. You will decide at the end of the day whether you want to buy or not. So the right to sell a given quantity of currency on or before expiration. So on or before expiration. So but I still want you Later, we'll be talking about the European option and the American option, since I'm using the word on or before expiration. Okay, the holder expects the price to fall. So if you have a commodity and you expect the price to fall in the future, what do you want to do? You want to sell. If spot rate on the excise day is higher than the strike price, the owner will be selling lower than the market price, thereby making a loss. Therefore, the holder will allow the option to lapse. The option will only be exercised. So this is very important. The option will only be exercised if the spot rate is lower than the strike price. So take notes of this when we start solving a question. These are this is what we give you the guidelines. Now, let me define some terms before we go further. Strike price. So when you are buying the option, the amount you are paying, or when you are selling, the amount you are selling is known as what? The strike price. So sometimes you may hear strike price, sometimes you may hear what? Excise price. They both mean the same thing. Premium. This is the amount to be paid to the seller of the option. Okay, so at the inception of the contract, because you have the option to buy or to sell. So now, because you have the option, you cannot make a loss. So for you to have that option, you have to pay a particular amount of money that is known as what? The premium. And the premium is paid upfront. The premium is paid upfront on the date the contract is entered into. So if premium is quoted in the foreign currency, it will be converted to the local currency using what? The spot rates, because the premium is paid upfront. Okay? So, European option. So what is the European option? This kind of option can only be exercised at expiration. When I did the definition, I said the holder has the rights or not the obligation to buy or sell a given quantity of currency on or before expiration. But for the European option, you cannot exercise the rights before expiration. It has to be what? On expiration. So you can't close out the contract before expiration. American option. This kind of option can be exercised on or any time before expiration. So basically in your exam, you'll be dealing with the American option in your strategic financial management examination. In the morning simply means that the strike price is more or is favorable than the spot rate. So that means you need to exercise. At the money, strike price equal to what? Spot rates. So you become indifferent there. Out of the money, you cannot exercise because what? The spot rate is more favorable. Therefore, you allow the option to lapse. If you exercise, you will be making what? A loss. So you will allow the option to lapse. What are the rules for choosing strike price? So you may get to the market and you have, let's say, June options. You have a strike price of 0.8246, 0.8349, 0.8350. Let's assume that you have this number of strike price and you want to buy. So if you are buying, there are 3 rules now. The first rule is choose the strike price closest to the exchange rates if the current, okay, let me just make this simple for you. This first rule, choose at the money. at the money. Choose at the money strike price. So if this is the futures price, or sorry, the option price, and spot rates equal 0.3 0.8349. So I'm going to look at this table. Do I have a strike price that is the same with this spot rate today? Yes, I have. So in this scenario, if I want to choose at the money strike price, I'm going to choose this because it is the same with the strike price. So that's one of the rules. There are several rules for doing this. Okay. So now what is the next rule? What is the next rule? So the next rule is to assume that the option will be exercised. In such a situation, you will not see the spot rate that is equal to what any of the prices for the option. So maybe you will see a different spot rate like say 0.9430. If the strike price is this, if you check this table here, the option table, sorry, if the spot rate is this and you check the option table, see that there is no strike price that is equal to the spot rate. So there is no at the money strike price. So what do you want to do here? You want to look at the transaction to determine which of the strike price you are going to be using. Now, if you want to buy a commodity, you want to buy at the lowest price possible. And if you want to sell at the highest price possible. So in this situation, if I don't have at the money strike price, if it is a call option, if I'm buying, which is a call option, which price is lower here, I will go with this amount here because it is the lowest among the three. But if it is a put option, if I'm selling, I want to sell at the highest amount. Therefore, I will go with what? This, which is the highest among the three. So before you make the decision, you have to take into consideration the option costs, which is the premium. So let me do something here, though I'm going to solve a question later. So let me just explain. So the option costs, if this is a call option, now we say you will go with the lowest because you are buying, right? It's a call option. So now what is the option cost? The option cost is the premium. So for each of these transactions here, the premium will be different. So let me assume that the transaction is a receivable. So if it's a receivable, what do you want to do? The cost is a payable. So if it's a receivable, you minus the costs, the option cost, let's say 0.1. So whatever you get for this second transaction, also you minus the option cost. And for the third one, you minus the option cost. So after you've taken out the option costs, the one that is still the lowest, that's the one that you will pick for a receivable. And if it is a call option. But for a payable, you are going to add the option costs. Okay, but let's still keep it simple here before we solve a question. So this is what I just explained. There are times when a company sets out its maximum exposure limits. If this is the case, you will choose the strike price corresponding with the limits. For instance, if a company wants to hedge an exposure at 1.10, you will choose the strike price that is 1.10. But most of the time in your examination, the examiner will not give you this. The examiner will either give you this or this most of the time. So the step to solve a question regarding the option contracts They are not, they are a little bit similar to the futures, but here there is nothing like closing. For your futures, you have the opening futures price, you have the closing futures price, you also have basis, okay? But in the option contracts, you don't have this, okay? So what you are going to be comparing, you are going to just be comparing the option strike price and closing spot rates to make your decision. Then you also have what? Your premium. All right, so let's just look at the steps. Step 1, determine the exposure. Determine the exposure. So the same way you determine the exposure for the futures contracts, that's the same way you are going to determine the exposure for the option contracts. So if you have not watched the futures contracts, do well to watch the introduction to futures contracts. But let me just still repeat it here to say for if you are buying, it's what a call option or option. And what do you want to do when you are buying? If you are selling, it is what a put option. Okay, so now what will now inform your decision whether you are buying the option or you are selling the option? We say there are two ways you are going to look at it. One, you are looking at the exposure, and the second, you are looking at the transaction. For a foreign currency payment, the company will buy because the company needs to buy that foreign currency to make the payments. So therefore, the company should buy options. For a foreign currency receivable, the company should sell because once this money is eventually received, it will be sold to the bank. So that is the decision. After you have made the decision, the next thing is to determine the number of contracts. After that, you choose your strike price, just the same way I illustrated above. How do you choose the strike price? Then you choose the premium that is corresponding to the strike price. The next decision is if you buy the call option at the start, you will sell to close. So if you buy to open, you sell to close. You should be familiar with that by now if you have watched the previous videos. So if you sell to open, you are going to do what? Buy to close. So it's just the opposites. Okay. Nastanco, a US-based company, expects to pay this. So this is the foreign currency. Okay. Try to look at when you are looking at the question, try to look at the currency involved. This is the foreign currency, and this is the company. And where is the company based? The company is based in US. And what is the currency for the US? That's USD. So the company expects to pay a supplier in the UK 750,000 euro. It is now October 1. This is today's date. Told you there are 3 dates that you have to be familiar with, which is today's date, the transaction date, and the contract expiration dates. And the payment is due on 1 March. So on 1 March, this 1 March is the transaction date. So this is the transaction date. This is today's date. Okay. The company wants to hedge the exposure using the currency option. The following rates are available. Contracts are quoted dollar per euro. So this is the strike price. Here is the strike price. So in this example, we are giving just one strike price. So there's no need for you to determine which strike price you are going to be using. So you just have one strike price. and the contract size is 125,000 euro. What is the requirement? Calculate the net costs of the payable and the effective exchange rate if spot rate on 4 March is as follows. Okay, so let's look at that. So in this question now, I have different closing spot rates. So the transaction date is when, this is the transaction date here for March. This is the transaction date. Okay, or 4th of March. Today's date is what? October 1. So this is today's date, 1 October. Now the transaction date is 4 March. And on the transaction date, we have different spot rates. We are assuming that there are different spot rates. So if the spot rate on the transaction date is this, should the company exercise the option from the rule I gave you? First of all, what do you want to decide? Your decision, should it be a call option or a put option? The company expects to pay 750. So will this be a put option or a call option? This is the foreign currency. Let me give you 2 minutes to make that decision if you are going to get it, if it is a put option or if it is a call option. What is the principle? You want to use the transaction. Is that correct? All right. So what is the transaction in this context? I've given you a clue. Okay, let me see if you're going to get it. Let me give it a minute. Okay, I assume you got it. If you've been following my lectures, I think you should get this. So the transaction is a payable. Transaction is what? A payable. And for a payable, the company, Nash Co, will need to do what? Buy the foreign currency. The company will need to do what? Buy the foreign currency, which is the euro. Since the contract currency is in the euro, there's no need to go for that. What the company needs to do is to do what? Buy option. And to buy option, you call it what? A call option. Okay, that's the first step. But the requirement, that's what we are looking at now. We are asked to calculate the net costs of the payment. Okay, you know the company cannot make a loss. So if any time the company is making a loss, the company will not exercise. The company will go with the spot rates. Okay, so now the company is buying at what amount? So the company is buying at 1.8250. So it's a call option. So therefore, the company is buying at this amount. If you open by buying, you are going to close by selling. Okay, so let's look at the first rate. If the company is selling at this rate, 1.8200, will the company be making a profit or a loss? You can buy at this amount, at the higher amount, and sell at the lower amount. Therefore, the company will not exercise this. If this is the closing spot rate, the company will allow that to lapse. Let's look at the second rate. The second rate is 1.8230. Should the company exercise? The company bought at 250 and the company wants to sell at 230. This is lower. No, the company will not exercise. So let's look at the next rate, which is this 1.8280. So if the company buys at this rate, will the company be making a profit? Buy at 8,250, sell at 8,280. Yes, the company will be making a profit. What will be the profit? The profit will be, okay, let me bring the higher figure up, 1.8280. This is your selling price, or you bought the commodity at 1.8250. Therefore, the company will make a profit of what? 0.0003 per euro invested. So this will, the company will go with the third exchange rate there, spot rates. So in this question, it is assumed that the premium, this amount is to be paid immediately, paid upfront, is $25,000. Now, if you look at this question, the premium is $25,000. So let's see what the solution will be. All right, so I've shown you the step. Step one is the decision. So we said, what is the decision? Since the contract currency is in the euro, the company should buy option, which is call option. I've explained this earlier on. So the number of contracts, what is the number of contracts? The number of contract is 750 divided by 125. And that will give how many contracts? 6 contracts. Okay. So call option is the option to buy. Last time who has the option to buy currency at 18250 and sell at the spot rates. Therefore, the option will only be exercised at 1.8280 because the company will be selling at a higher price. Okay, so I've explained this. And the gain will be what? This minus this will give you the gain per euro invested, which is 0.0003 times 750. So that will finally give you what? 250. So if you observe, the gain is not in the euro. The gain is what? Is in the USD. So why is it so? So you may don't make that mistake in your exam to now put the gain in the wrong currency. So let me show you why it is so. So your gain or your loss will always be what? In this currency. So let me clear this. Let me use the strike price. So your gain or loss must always be what? In this currency. That's the currency of the strike price because you are buying the euro using what? This currency. Okay, so this is the table for the solution. So I've explained most of what is in this on this table. So this is the strike price, and this is the closing spot rate. So at this amount, we said the company will be making a loss, so the company will not exercise. At this amount, this amount, the company will also be making a loss. For this amount, the company will be making a profit. Therefore, the company should exercise. Okay, so if spot rate is 1.8200, what will be the effective rate? Okay, so there are two contracts here, just as it is with the option contract. There are two contracts here. One, the option contract. Two, the contract for what? The payable. So on 4th March, two things are happening. One, the company is closing the option contract. Either the company is going to be making a gain or the company will allow the contract to lapse. So in this scenario, at 1.8200, the company will allow the contract to lapse, and the company will just go straight to the bank and make payment to the supplier. Okay, and if that is the case, the company is expecting to pay this amount in what? In euro. And closing spot rate is 1.8200. So how much will the company be paying to the supplier? This is what the company will be paying to the supplier. So 1.8200 is the closing spot rate. And the amount to be received is how much? 750. So in converting, because this has been converted, in converting, will you be multiplying or will you be dividing? Will you multiply or will you divide? Let me give you 30 seconds to make that decision. So I assume you got it. The first question you want to ask yourself, is it a direct quote or an indirect quote? Now, this exchange rate is in what? Is in the USD. Okay, so the contract is in the USD per the euro. And the company is US-based company. So the contract is in 1.8250 per the euro. The spot rate is 1.8200 per the euro. So since this currency here is in the local currency, it is what? A direct quote. Therefore, you multiply. So if you multiply this by this, it's going to give you this amount. Okay? So but remember that there is a premium that was paid for this contract. So if that is the case, what will now be the effective rate? What will be the effective rate if that is the case? All right. So for a payable, you are making a payment. So two things will happen here. Now, this premium is a payment. This premium is a payment. And this is also what? A payment to the supplier. Therefore, the total payment that has been made regarding this contract is what? This amount. This amount relates to what? The receivable. While this amount relates to what? The option contracts. So the effective rate becomes this amount. So how did we arrive at the effective rates? The amount that is being expected is 1,390,000. This is dollar. The quotation is dollar per euro. And the euro you are expecting is 750,000. 750,000. So this divided by 750,000 will give you this amount. So the same principle we apply for this and what this. Okay, this is just the same with this, but since here there is a gain, right? Since there is a gain here, this is the gain. So if spot rates on the date of the transaction, 4th March, is this amount. So how much will the company need to make that payment? It's going to be the amount the company is expecting to pay, which is 750,000 times closing spot rate, the spot rate on the 4th of March, 1.8280. So that will give you this amount, which will be what the company will have paid if the company did not enter the option contracts. Okay? But because the company has entered the option contracts, the company has made a gain. Okay, but before the gain, because of the option contract, the company made a payment of what? 25,000. So that will increase the costs on the company side. So I need to add these two amounts. Okay, but from the contract, the company made a gain of what? 2,250. As a result, the costs will reduce by that gain. So the net payable will now become 1,393,750. So what will now be the effective exchange rate? The effective exchange rate will now be this 1.8583. But it being the company did not enter any of this contract at all, this is what the company will have. This is what the exchange rate, effective exchange rate, will have been 1.8280, which will have been much more better than 1.85. Okay, so this is just the introduction to option contracts. So if you understand this basis, by the time we solve a more comprehensive question, you will be able to understand how to go about it. So in my next video, I will be solving a question that has the combination of a forward contract, a future contract, and also an option contract, so that you will be able to understand the way this question will be tested in your examination. Thank you for watching.